those are the golden days of distress real estate debt, buying from the RTC, those pools, and people are making 30, 50% IRRs. With every cycle and decade since the 90s, both the government and the banks have become more sophisticated. So more recently, when the government was selling First Republic's distressed loan book, they learned, and so they sold the majority of the book, I believe, to Blackstone. But the government said, we're going to keep 90% of the recovery and profits, and you, Blackstone, get 10% in an asset management fee.
Good afternoon, everybody. Welcome back to Confronting the Impossible. My name is Leo Jacobs. I'll be your host. And this is where we discuss the trials and tribulations of the people that are in distressed real estate and of the actors in distressed real estate. I have a very special guest with me today. I'm very proud to have him along. He's a good colleague and part of the distressed industry, Rob Deckey of Multi-Credit Partners. And he's been in the distressed industry for probably 30 plus years. And I'm very proud to have him here. Welcome, Rob. How are you today?
Awesome. Thank you.
Excellent to have you. Thank you very much for coming over to our Fifth Avenue office. It's very nice to have you. Please, for the people that do not know and are listening, tell us a little bit about yourself, an elevator pitch, if you will, please.
Sure. Thank you, Leo, for having me here.
My pleasure.
So by way of background, I graduated from business school in the middle of the S&L financial crisis. Thinking that was a terrible time, I actually got the best lessons of my life on distress investing and how real estate values can go up and down very quickly. So I worked for a dozen years in investment banking at JP Morgan and Citibank, doing REIT IPOs. And at the time, these IPOs happened because whether it was the Towman Company or parts of Trammell Crow Residential, they were suffering under lots of debt. And so the REIT market opened up to provide the equity to pay off those debt and give these developers a second life. So I worked on the IPO Prologis and many of the good REITs today that exist. So having seen how those developers had to reimagine themselves from being private company, over-levered, high recourse borrowers to becoming public company CEOs, and how they had to morph their companies many times from regional players to national players and grow through M&A to become multi-billion-dollar companies, was very fascinating in my formative years of my career as the dozen years I spent in REIT banking. And then in 2001, when we had the dot-com bust, a company that I had filed an IPO for on the tails of SL Green, George Comfort and Sons, stayed private. And so I joined them and worked there for 13 years, doing mostly distress office investing, using really the skills I built on earlier in my career. And then in 2015, I saw the end of the lack of the future of the office world, decided I needed a new career, and joined Invesco, where I was until recently for almost a decade, running the New York office and East region. And they're really diversified into many other property types as just a good investor. And then in the last year, I was looking for where there is further dislocation and have really identified multifamily refinancings coming up, having the second highest default rate after office in the mortgage sector as an opportunity to provide a solution to the impossible. So that's a snapshot of my career.
Excellent introduction. I actually want to start from the very first thing that you did, which was taking private CEOs and
taking
them public. Am I correct?
Yes.
So they were private CEOs.
They were private companies, and they saw the public market public equity is cheaper than the bankruptcy they were facing by many of their lenders. So the way to pay off those loans, pay down their debt, and reform their companies as public REITs.
And when they did that, what must they have done in order to get out from under? What did those CEOs have to do?
Well, they had to.
Because they were confronting their own impossible.
Correct. The number of banks that were going out of business and the RTC. And that brings me to the evolution of distress investing. So in the early 90s, when the government took a bank over, they would just flash sell the loans, distressed loans, to the highest bidder, which was at the time just this small company called Blackstone, Morgan Stanley, Whitehall. And so there are just very few distressed debt real estate buyers. And the government was very inexperienced, and they just sold these loans for pennies on the dollar. And Blackstone, those are the golden days of distressed real estate debt, buying from the RTC, those pools, and people are making 30, 50% IRRs. With every cycle and decade since the 90s, both the government and the banks have become more sophisticated. So more recently, when the government was selling New York Community, First Republic's distressed loan book, they learned, and so they sold the majority of the book, I believe, to Blackstone. But the government said, we're going to keep 90% of the recovery and profits, and you, Blackstone, get 10% in an asset management fee. And so there's less distress today than there was 30 years ago, because less distress available for sale, because many of our lenders, commercial banks, insurance companies, CMBS trusts, special servicers realize that by doing blend and extend and not flash selling loans at the bottom of the market, you can have a much higher recovery. So
recovery for
the original principal balance.
Not only the interest.
Not only the interest, but also principal recovery.
So now that stresses the current lender.
So a lot of lenders today, including the federal government, if they take back loans, will work with borrowers to do pretend and extend. So you're not selling in the moment of where the market is at the trough. But if you can work out a solution and sell it in a year or two, you'll have much better recovery than at the moment of the crash.
So, Rob, I want to challenge you here.
Yes.
Because we're not in the 90s. We're in 2026.
Right.
And the private market is not allowing some of the clients that I represent or some of the restructuring firms represent to breathe. They are acting as the fiduciaries for their investors. A prominent example is Charles Cohen. Charles Cohen is being foreclosed on, as you know. Just today, he lost his prized possession, which was 750 Lexington, to his lender to pay the lender back on his personal guarantee of $185 million. That's nothing to sneeze at. And there was no pretend and extend there. There was a vicious attack an aggressive attack by Fortress on his assets. And that spoke to, I guess, a change course in the way the 90s had been fashioned, where they weren't sophisticated and not in the way that people were pretending and extending about 2 years ago. Right now, people are taking their assets for the betterment of their investors. So my challenge here is there a road here today that it's still going to be blend and extend, pretend and extend? Because I'm seeing something very, very different. What's your opinion on that?
Well, I think in the special situation of Charles Cohen, correct me if I'm wrong, Fortress had provided him a very highly leveraged personally guaranteed loan. So they are not the most friendly of all
Well,
lenders.
then you have Maverick.
And Maverick. So these are guys that are making highly leveraged loans with a lot of personal recourse. And so that's why they can go in and be the tough guy and force the sale of these assets. However, I think if you look at more insurance company, traditional senior commercial bank loans, or even CMBS trusts, they are frequently, because you have a senior lien, especially in New York, it could take 2 years to go through the courts to foreclose. People will work with the borrowers to, they understand, for example, office, you have a high vacancy and income is down. It's hard to refinance today. But even in the case of office, 2 years ago, it was impossible to get an office loan. Today, the SASB CMBS market and even the bank market for certain office buildings has reopened. And you've seen a recovery over the last 2 years in the office lending market. Obviously, it's not where it was pre-COVID, but it is much better than it was 2 years ago. So I think in general, senior lenders, the ones I mentioned, will work with their borrowers, if the borrowers are doing the right thing, to figure out a solution to recover some of the principal and interest loss and not do a flash sale or take over the asset. I think in the situation of Charles Cohen, that was a very highly leveraged personal guarantee loan across his portfolio, and that was a very different situation.
It was an exception to the rule, you're saying.
More on the fringe of, aggressive lenders than a more traditional senior lender.
So I'll challenge you one more time about what you're doing, but maybe before I do that, why don't you tell us, now let's fast forward from 90s to now quickly.
Yes.
What are you doing now that is confronting another impossibility?
Correct. So historically, as a distressed investor, I would love to go buy distressed loans and distressed buildings. However, because the lenders and the Federal Reserve are more sophisticated, there isn't the large amount of distressed loans for sale at discounts in the marketplace.
Interesting. I didn't know that.
And because of that situation, but you still have the second highest default rate in multifamily, we see a situation where in the next 3 years, 180 billion of multifamily loans are expiring, over 80% loan to value, because many of these borrowers, when interest rates were low in 2020 and 21, were borrowing at 3.5%. The new rate on that mortgage today is 5.5% and 6%. 4 years ago, they were borrowing at 65% loan to value. But nationally, apartment values are down 20%. So those loans now are 75 and 80% loan to value. And I think that has been well publicized in the Wall Street Journal. Apartment performance and rents have been very soft due to some of the overbuilding. So a lot of these borrowers, middle market borrowers, are having a challenging time facing the impossible because, one, the Federal Reserve has told the commercial banks that they have to have 5 times the reserves to originate a senior mortgage versus providing a repo line to a debt fund. So therefore, commercial bank loans to commercial real estate in 2025 hit an 11-year low.
Because the Fed is not allowing.
The Fed is motivating banks to provide repo lines to debt funds rather than originate direct senior mortgages.
What is a repo line for the people that don't know?
For a debt fund, it's providing bank financing, typically around 75% of the loans that you have in your funds. And that's called back leverage, that the commercial banks are providing the Blackstones, TPGs, their mortgage funds.
To do what?
To go make loans directly rather than have the commercial bank use depositor money to make that direct commercial real estate loan.
Why do they want to give money to people like Blackstone and not the commercial banks?
Well, because a few years ago when First Republic, New York Community Bank, and other banks were starting to have runs on the bank and defaulting, the Fed realized that direct commercial lending can be quite risky. And so when that financial crisis happened a couple of years ago, the Fed decided to change the reserve requirement to motivate the banks not to make the direct mortgage, but provide the back financing to the Blackstone. So that way the debt fund is at risk for that last level of financing and not the depositors' savings money.
Effectively, the depositors being the citizens of the United States.
Correct.
So
it made the banking system more stable. This created this void in the marketplace where now over the next 3 years, we have $180 billion in multifamily loans expiring over 80% loan to value. You have the traditional lender to those developers, the banks pulling back. And so this is creating this void in the marketplace of all these refinancings. And so they're all being extended, giving the developers more time to finish leasing up their building and executing their business plan. So multi-credit partners sees an opportunity to come in and provide senior bridge loans to these multifamily borrowers, 65 to 80% loan to value at reasonable spreads, SOFR plus 300 to 400, to help them refinance the loans that they have coming due and expiring.
And you believe that there will be no extending and pretending?
No, I do think there's a lot of extending and pretending happening, but those lenders want to get paid off. And so we're providing the refinancing capital so the developers can pay off their pretend and extended loan. And we are giving them a new 3 to 5 year bridge loan to help them finish to execute their business plan.